You spent a lot of time on your earnings call yesterday, and you've spent a lot of time over the past year talking about opportunity zones. Maybe let's talk about, for those that don't know, what is an opportunity zone, and then why for you guys in the opportunity zone, what is maybe that size of the capital commitment that you guys are willing to do to grow in this space?
So the first part about opportunity zones, it was an incredibly brilliant idea, and I know Senator Booker from New Jersey is involved in it, Senator Scott, and others. I mean, think about any state's most economically depressed area and all the socioeconomic problems that it causes for an area to be economically depressed. And realize the fact that if you went to those areas 5 years ago, there was probably no hope there. In an area that's stagnant with nothing happening, it just goes downhill. It's a bad thing. And we did business in areas like that. We came to North Nashville before anybody else, made investment in a property, turned it around, watched the people who owned property next to us follow our lead and invest in their properties. Another CEO of a publicly held company, we both bought properties next to each other. He followed our lead. He didn't want us to object to his use. It's actually a little bit of a funny story. You've heard that, people will object to manufactured home communities, and they'll object and they'll make derogatory comments about manufactured home communities. Well, our neighboring property, he's not a junkyard, but I'll use that term. What he actually does, he has a very sophisticated company. It's LKQ, and they're after parts automobiles. But what they do is they very neatly and cleanly stockpile the automobiles to take the parts and resell them. It's a very successful publicly held company. But if somebody wants to be derogatory about manufactured home communities, they'll call us a name. If somebody wants to be derogatory about aftermarket parts, they'll call them a name. But we wound up right next to each other. And so I spoke to the CEO and I said, look, we're not going to have any objection to your use, but why don't we both speak to the mayor and the chief of police and tell them that this should be a very nice area of town, that we're both investing in these properties here, and we'd like to help with whatever programs you have to improve the socioeconomic condition of this area. And we did that, and the turnaround in the area was dramatic, so that somebody else built an apartment complex across the street from us we were worried that was going to negatively impact us because there was so much supply coming online, but didn't negatively impact us at all. We just vastly improved this North Nashville area in a very short period of time. The point being, I know opportunity zones work if people invest money in them. And so the concept is, if you have a capital gain and within 180 days invest that money in an opportunity zone fund, then you will defer your capital gain for 2 years at this moment. They might make it 4 years. And that's a nice benefit, but it's not the best benefit. The best benefit is when you hold that investment for 10 years, you get the stepped up basis. So if you bought real estate and invested in it, you can't just buy it and do nothing. You have to improve the property and invest in the property. But if you do that and the property doubles in value, so your $1 million becomes $2 million, at the end of 10 years, you get the stepped up basis. So your $1 million investment counts as $2 million. You owe no capital gains tax. And so you have a 20% federal capital gains plus a 10% in most states. In New Jersey, you have a 10% capital gains tax. So you save 30%. So you make $1 million, and without the opportunity zone, you net 700,000. But in an opportunity zone, you net the whole $1 million. So it's very exciting for investors. And the nature of an opportunity zone investment is you have to hold it 10 years, which gets you away from the Wall Street short-termism. We always see deals, but we always have to balance, most turnaround properties or development is going to lose money for 3 to 5 years. So there's a limit to how much UMH wants to do of that, because we don't want to stop our growth in FFO. So, it's nice to do 1,000 lots per year, but we don't want to do 5,000 because it will negatively impact us. But in the Opportunity Zone Fund, people can know that they're not going to make money for 3 to 5 years, and that will be okay with them. And they're paying UMH asset under management fees and management fees, so we're not losing any money. And we get the first right of refusal to buy the community once it's turned around and making money, which is, that's a major, major advantage to have a source of deals based on appraisals. You don't always get first crack at a community. So we would get all of those things. And, there are more communities that need turning around in opportunity zones than anywhere else. And you're not going to get that not in my backyardism in opportunity zones if you're trying to build a community, because people want the economic investment. So we're very bullish on how manufactured housing is needed, affordable housing and communities are needed in opportunity zones, how the nature of the investment is long-term capital, and how we could provide, very good returns to opportunity zone investors without making any money for them during the first 3 to 5 years. So it's an exciting concept, and we're working on that. It's very similar to our Nuveen joint venture. The difference being the Nuveen joint venture, we're a 40% investor in communities to be built. In the Opportunity Zone Fund, we've already invested UMH's capital gain from the Monmouth transaction, but we don't know, what percentage we'll invest versus the outside investors.
I want to come back to the Nuveen JV real quick, but I want to ask on the Opportunity Zone. Would you go into a new state like Wisconsin, let's say, or North Dakota, if the Opportunity Zone investment presented itself? Is that enough of a reason for you to enter a new state?
So let's go to the first part of new states. Let's instead of the whole question of opportunity zones, I'm going to break the question down to two phases.
Sure.
One is the new states. So for many years, UMH turned down acquisitions in other states for a couple of reasons. Number one, if it's not big enough to give us scale, it's going to cost us money to operate in the other state. Number two, in the old model of manufactured housing, where the resident owned the home and rented the lot, if there was a lot of inexpensive housing in the area, so in New Jersey, nobody's going to buy a quarter acre of land with a house for $250,000. It doesn't exist. That house is going to cost $450,000 or more. So manufactured housing always works because we're always less expensive than a $450,000 house. But I could take you to Kentucky, Tennessee. I could take you to lots of places in the country where there are $250,000 houses, where somebody can have a lot and a house. It might be a used house, might be an older house, but they exist. So when that's the case, manufactured housing has, serious competition. And so it wasn't that exciting to go do a 4-cap manufactured home community in another state when you were going to have that issue. But going to rental homes, when you take the rental model and realize we can rent a home for $800 per month, and people building or having apartments, they're $1,200 per month, and they might be 2-bedroom and we're 3-bedroom, 2-bath. There's no competition. And so we see it, in the Western New York, Central New York area where we're located, that people will move out of existing apartments into our product. So even though demographically New York loses 1% of their population per year, even though there's inexpensive housing surrounding us, but the rental model works. So knowing that the rental model works, and I believe it will work just about anywhere, we are much more inclined to go to new states today. And just like we went to South Carolina and Dothan, Alabama, you have to get your foot in the door. You have to be there for the realtors to know to bring you other communities, for people to know to bring other communities. So even though it's inefficient and costs money to establish ourselves there, we're doing it. And this goes to the long-term picture again. What we're studying today, Walmart, Lowe's, Home Depot, Burger King, McDonald's, companies that have gone national. We have a product that works. It's the manufactured home community consisting of rental homes plus a percentage of resident-owned homes. We sell people homes because it's beneficial to them. If you're renting a house for $800 per month, you're going to get a 4% increase every year, $32. If you own the home and rent the lot, $400 is lot rent, $400 is your home payment. Each month, you're reducing the balance of your loan, paying that $400 per month. At the end of 20 years, that $400 per month is going to be gone. You're not making any payment on that. It's pure equity. Today, manufactured homes are, I've read articles, they're appreciating in value faster than conventional homes with land because of the demand for affordable housing. So that home could appreciate, it could stay flat in value, it might decline in value. Well, it depends on how you take care of it, et cetera. But whatever it is, you're going to have no more payment on that home. You have the ability to sell it to take cash out. You may have the ability to sell it to earn a profit. So the homeowner has a major benefit, and when they get that 4% increase per year, it's only on the lot rent. It's only $16. That goes up a little every year. But at any rate, it starts out at $16 versus the rental unit. So it's in our residents' interest to own the home if they want to own it, if they're staying long term. But the rental is in our interest because the demand, it's 8-to-1. We're renting 8 houses out for every one we sell. So this new rental model means we can go to new states. And again, what I'm trying to portray is this big picture that we've discovered before everybody else, that in the workforce housing world, the model of a manufactured home community with a percentage of resident-owned homes and a percentage of rental homes, and Fannie Mae makes that percentage 60% because they lend with up to 60% rental homes right now. We're working on changing that. They're going to do Memphis Blues for us, which is 100% rentals. But until we do change it, the mix should be about 60-40. It works. And so now, just imagine you discovered how to do Lowe's or Home Depot or Walmart, whatever it was. Now the question is, how do you grow it? So I have a friend who's does Dunkin' Donuts, and sometimes it's more expensive to buy Dunkin' Donuts, to buy new stores, and sometimes it's more expensive to build them. In our case, at this moment, it's more expensive generally to buy them than to build them, so we're building them. That those turnaround properties, 30% occupied, 70% occupied, they're generally the only opportunity out there because everybody else wants to buy your 95% sub 4 cap communities. So that's what we're doing and how we're trying to grow.
When you decide to start looking in Hawaii, and if you're looking for a guy out there,
okay,
we could have that conversation.
So I left out the opportunity zone part, so I'll just go to that a second. So opportunity zones create even greater opportunity because there's just more existing communities that need to be turned around. There's more land you can get approved to build communities, and the demographics are not there today. So anybody who's only looking at today is going to say, I wouldn't do this deal. But UMH isn't looking at today. We're looking at, look what happened to us in North Nashville. We can turn these properties around. Other capital will follow us. And the greatest deal we ever did was Holiday Village, north of Nashville. I forgot the number of lots, but it's approximately 200. And we were able to build an expansion that we're building now. You could see the city of Nashville from it, but you knew it was a community that needed a lot of work in an area that needed a lot of work. Both happened, and it's one of our most successful communities ever.
That's great. Let's talk about third-party capital, because you did mention the Nuveen joint venture. Do you have the appetite to do more investing with third-party capital?
Yes, we do. The object is how do we get long-term capital that can be patient? And, that the minute you say that, you're not talking about Wall Street. So now you're talking about long-term patient capital is going to come from other sources. And we can do, just like the Nuveen joint venture, we get asset management fees, asset under management fees, plus right of first refusal. And we can make it beneficial for both of us.
That's great. I do want to pick up one more question on that portfolio, because you've been talking about the rent versus own. And in chatting with my portfolio manager, we're trying to figure out what is that optimal mix of rent homes versus rental sites in a community. Where do you see that mix going if you had to guess? What would be company owned to residents versus resident owned? Do you have an optimal mix in mind?
Not really, because every community is different, right? So there are plenty of 55 and older communities that are 100% resident owned. And there's probably no reason to change that, because we can make a large commission reselling the house. When I say large, it's 6%, but the house might be selling for $200,000. And it maintains its, full occupancy, minimal turnover, and you're really not going to change that community. There's no reason to. When you're dealing with a 30% occupied community that you're going to turn around, you're going to add rentals 8-to-1. As far as I'm concerned, there's no need to ever sell a house. We've discovered the horizontal apartment complex. It's kind of like when I was a kid, there was a TV show, the Jetsons. What's the future going to look like?
Did you know it was his birthday this week?
I didn't know it, but
George was born this week.
I'm glad to hear it. It was a great TV show, and I'm glad I picked him on his birthday. So, we've discovered that rather than build the garden apartment, right, which people would build and they lasted 50 years, but 50 years later they're obsolete. They're still in use, but they're obsolete. A manufactured home community, 50 years later, you're just going to replace the homes. If they're obsolete, they may not be obsolete, because homes built in the 1970s lasted 50 years. The homes of today are far better. But if you need to just replace the house, you can replace the house. And the person has a 50 by 100 lot. They have a driveway. They have a shed. They prefer it. And when I drive around here in Monmouth County, New Jersey, and I look what people are building as affordable housing, which costs twice as much as our product and rents are twice as high, it's not, in my opinion, what people want. They're going to take it because they don't have a choice. There's no other housing available. But would people prefer a common wall neighbor, a shared, garages right next to each other, driveways right next to each other? Or would they prefer a 50 by 100 lot with their own driveway, their own yard, common area? We have common amenities. We could have a swimming pool, clubhouse. But I've watched people move out of apartments into our product, and they do it rather rapidly. So I think what I'm considering horizontal apartments, a manufactured home community with all rental housing, is highly desirable. And then you look at how many rental home REITs have been created and how many people have gone into the rental home business. And, their model's good, but our model's better. We're taking 50 acres. On 50 acres, you could potentially put 400 homes, 8 per acre. You could even put more than that, but you can comfortably put 8 per acre. So 50 acres, 400 homes, one management office managing 400 homes on 50 acres. It's relatively easy to do compared to your residential home REITs that would be managing 400 homes over many, many square miles. So our model just works, and it continues to work, and it's fantastic. So the objective is grow it. And if you're trying to build communities, that's very long term. I've got approval projects that I've been working on for 15 years and don't have the approvals. Wow. And then where you do get approvals, because UMH has a great reputation of, if we turned around a community, the mayor and the town, they watched us turn it around. They watched us make it a better place to live. They've watched us take what could have been an eyesore with crime problems and make it a great place to live. So when we tell them we bought the 50 acres adjoining us and want to expand, they're fine with it. Additionally, employers are our greatest ally. If somebody's got a business that needs workforce housing, they will become our advocate, knowing if we build 200 units, they have 200 more people that are going to be in town that could potentially work for them, that they could pay an affordable wage, because that wage will buy them quality housing that they're going to be happy with. So those people, we're near Smuckers, we're near Scott's, we're near Stewart's in New York, we're near all the Marcellus and Utica Shale employers, but those people who employ people and know they need a growing workforce, they're all for our expansions.
Do you see operating cost pressures persisting or abating somewhat going into next year?
So this is a complicated year. Number one, during COVID, We probably weren't hiring as much. You did less visits into people's houses. So you were able to operate with probably the leanest staff you'd ever operate under. So the fact that we had to increase the number of employees after COVID, and the fact that, labor was more in demand and so wages rose, I don't think that should be any surprise to anybody. And so it resulted in our 8% expense increase. Additionally, you have tax increases and everything you're doing, whether it's tree removal, whatever you're doing, your suppliers have the same labor issues that we have. And so the cost for everybody goes up, and, add to what gasoline does to everything. But long term, I don't believe there's any reason for the inflation. Again, we're in the Marcellus and Utica Shale area. We have the ability to reduce our U.S. energy costs. We have, extremely smart people working in this country that really can reduce the cost of products, and that's what we're supposed to do. So labor can find increases in real wages while you don't have inflation. So all of that is very doable. COVID threw a monkey wrench in everything. So I believe long term, even though our workers, our staff, everybody around us will receive wage increases and their wealth will increase, it's not an inflationary increase. So we will continue to pay those increased wages, et cetera, through growth of the company, having additional rental units, additional home sales, additional lots. And it's the same with, the current situations. We raised rents 4%, expenses went up 8%. We filled a number of rental homes, but not the 800 we wanted to because of the supply constraints. But next year, we'll fill 900 units. So the wages can increase without affecting profitability.
What about technology? Is technology able to help mitigate your expenses? I think about like the self-storage guys. I can rent a property on my app and never have to interact with somebody. Does technology help you guys as well?
Well, so in terms of separately metering water and sewer, it reduces usage 30%, which reduces the bills 30%. We go to more efficient streetlights, et cetera, which reduces costs. We've gone to direct payment of rent, which stops the office person from having to drive to the bank every day to deposit checks. So technology definitely reduces costs in every way, and it reduces costs for the manufacturers. Skyline's talking about how they're going to continue to refine the production line to reduce costs. So all of these things help.
Now comes my favorite part, where we get to do what I call the soft touch, the little softball type questions. So we'll start out with, for those that may be new to REITs in the sector or real estate in general, why should investors care about publicly traded manufactured housing REITs compared to something non-traded like Blackstone's REIT, BREIT?
So REITs, publicly traded REITs, give you income. We have to pay out 90% of income as a dividend. So if you're looking, the best place you could possibly own a dividend-paying REIT stock is in your retirement plan, like a 401k. You get that dividend every year without it being taxed. It's taxed, but it's tax deferred. So the growth, what it would do to your retirement plan, your FFO, what the FFO and the dividend will do to your retirement plan is just incredible. And everybody in our company's seen that through holding UMH stock in their 401k. REITs give you liquidity. In a non-traded REIT, whatever happens, you're in that non-traded REIT. And in a publicly traded REIT, everything gets valued every day. So even if office is collapsed because of COVID, you have the opportunity to sell that stock and get out at a certain price. Now, many people, including me, believe office is still a good investment, right? That there's plenty of offices that people need and it's a good investment. But the stocks in office REITs have fallen dramatically. And if you wanted to sell, you could sell. You had that personal choice. In a non-traded REIT, you don't have that personal choice. So the liquidity that a publicly traded REIT gives you, it has different effects on different people. some people can't stand to see the value of their stock going up and down. So maybe a non-traded REIT is the vehicle for you. But some people recognize that that fluctuation in your stock price is your liquidity. And if you're in a non-traded REIT, whatever the value is, it is, but you can't sell that, and you can get the dividend if the dividend's there. But every business is a business, and every business faces internal and external obstacles, and we can't predict the obstacles. Nobody predicted COVID. So being a liquid, publicly traded REIT gives you the opportunity to react to what's going on, and you lose that opportunity in a non-traded REIT.
That's a great answer. I like that. How can all investors benefit from a long-tenured management team and a deeply experienced, qualified board of directors?
I think that's one of the most incredible things about UMH. So I work with my father, Eugene Landy, every day. He's 88 years old, graduated Yale Law School, went at Kings Point Merchant Marine Academy. It's like having a coach every day. Like you're going to be told you're not the best runner, you're not the best football player. There's things you could do better. Some people can't stand to be coached, but being coached has its advantages because you could look at what you're doing and think that everything you're doing is wonderful and perfect. But in fact, there's things that can be done better, and there's ways to improve them. So having our long-term tenured management is an incredible advantage. My father can see things that, you could pick. He's a member of the Princeton Economics Council. He goes there, and he can seriously contribute when speaking to the top economists in the world. So to have his insight and his guidance is, absolutely invaluable. And then you go to, all of our directors. All of our directors have various backgrounds. We have a realtor, a public relations person. We have bankers, lawyers. We have a person who was a CEO of a bank, as well as being the head of an audit committee on a REIT. They bring extensive experience, and that's what you need, because my best example is in 2009. Everybody knew the housing market was collapsing, right? Nobody was hiding it. It wasn't a question. But there was a period in early 2007 when our sales were starting to fall, and there were people who could blame management. Why are your sales going down? Well, many other people weren't, stating there's a problem here. They were trying to get through the problem, but they weren't stating home sales are dropping off a cliff. But if you have a board of directors that's in the business and out there and has experience, they know what's going on. They know the problem's not management. They know it's a macro thing. And so the guidance that they can create and their willingness to stick with management and say, yes, we have a problem here. Yes, earnings are going down. Yes, we need to cut the dividend. But we don't need to chop anybody's head off because of it. It's the macro picture, and we need to make sure we have liquidity and we adjust so we can get through this cycle to get to the next cycle. That's the purpose of your board of directors, and they really serve that in the past and will serve it in the future, because they're people who are in touch with the real world. They have their finger on the pulse of what's going on in banking, housing, public relations, law, accounting, all the various areas. My brother Michael's a director. He went through the entire Monmouth REIT matter, and his insight into, proxy advisor firms, how you handle activist investors today, those things are invaluable. And I, as the CEO, have the advantage of speaking to those people at will. Like, if I call, they'll answer. There's also an incredible benefit in being a publicly held company that, each person in private business should really do, and I know they don't. But if I was in a private business, I would create my own board of directors meeting every quarter, because to prepare for that board of directors meeting, to think about where your company went the past quarter, where it is today, where it's going to be next quarter, and what you're doing long term, to have to stop working because you're normally doing something, right? You're hiring people, buying properties, selling houses, taking care of day-to-day problems. But basically, we have to stop working on our normal business, for more than a week before the meeting, for the meeting, and maybe for time after the meeting, doing things that came up from the meeting. But that's incredibly valuable for your business, short term and long term. So if I had my own private business, I'd create my own quarterly board of directors meeting, even if I was only talking to myself, because the advantages of studying what you did each quarter and what you're going to do are incredible.
That's great advice, actually. We actually do that internally with our team. So it's comforting to hear you say that. You've referenced your father several times. Sorry he's not here joining us today. It would have been great to put him on the spot as well. But for you, did you feel pressure to come into the family business since you grew up as the son of REIT royalty?
Well, my father created 2 REITs when I was 8 years old, so I didn't feel any pressure. I knew the REITs existed. I knew what they were doing, and I never felt pressure at a later date. Just like I don't believe I have 3 sons. I don't believe they feel any pressure. My son Daniel's with us full time as a vice president. My son Jeremy is with us, traveling to properties, doing drone videos, and he has an incredible relationship with our managers and our staff and our residents that can only be had from being at the properties. So it's not pressure. It's I know Terry DeCio, I know Kevin Clayton, and both of their fathers. Art DeCio founded Skyline. Jim Clayton founded Clayton Homes, and really you grow up with it and you fall in love with it. Whether it's the house, the customers, the communities, it's something you want to do. It's not pressure to do it.
So when you went to college, you knew you were going to be going into the family business?
I wouldn't say I knew that then. What I knew was I was going to be in business. I was a business major. I had worked at Sandy Hook Concessions for a guy named Eddie Siegel. But the most incredible part of that story is I worked with his nephew, Ken Siegel. And Ken Siegel is in Steve Jobs' biography because he thought of putting the I in iMac, iPhone, iPad, his public relations firm. I knew him, worked with him, and knew, I was 15 and 16 years old, that he was an incredibly talented person. So I always knew I wanted to be in business and wanted to be doing something that was going to be big in business, which is certainly what Kenny did. He did Apple and wound up in Apple's book. I did UMH and wound up here with you today.
And this has been great. So a couple more for you. You mentioned college. If you could go back to 22-year-old self you, what would you tell yourself today?
So what I think about is this. It's actually biblical that any man is less than half of what he'll be when he meets his right spouse. So anything I was before I met my wife and got married is less than half of what I'd be today. And I would say that when you're young, you're a caterpillar, and later you turn into a butterfly. So I was a very good caterpillar that had a lot of fun, and I recommend that to everybody. You should grow, you should enjoy, you should learn. But who you're ultimately going to become and what you're ultimately going to be do really shouldn't have anything to do with what you're doing at 22. You should gain experiences. You should study. That's what a liberal arts degree is about. It's about tasting everything, knowing everything, not knowing, but learning about everything and having an open mind to everything, so that later when you have to focus and do one thing day after day, 70 hours a week, you're prepared to do it and know you did what you wanted to do when you were young.
What's the one lesson that you've learned as a CEO that all investors can benefit from?
As a CEO, your job is to create direction, just like we just did that exercise of where we'll be in 5 years. But, I know lots of people who are really good at what they do. Could be a great electrician, a great plumber, but they're not going to grow their business because they're not willing to rely on other people and understand other people's strengths and abilities. So as a CEO, you have to take the time to understand people, to look at their strengths, to have confidence in them, to use all the training programs that are out there so that people get training, so that people learn to do things on their own. You have to measure the results and create the goals and the objectives as to where you want to go. But really, you have to have the confidence in everybody with you that we all make mistakes along the way, that as long as the person's objectives are to do the right thing and that they long-term want to grow and do the right thing, you can get through the problems and create a fantastic organization.
If we had a crystal ball sitting right here in between us, let's play a couple of the what does it look like? Again, forward-looking, way down the road. What would you say a typical property looks like 20 years from today? What do you think UMH looks like 20 years from today? Because I'm guessing your father's vision in 1968, I don't know if today is exactly what he had pictured, so who knows what it looks like down the road. And what do you think about consolidation in the industry? If that crystal ball, do you think we have less players down the road, more players? What do you think that landscape looks like?
Well, first of all, the new communities that we will be being built 20 years from now, I hope they solve the transportation issues. You know, the car is an amazing thing and people love their car, but there's got to be a way to build communities that have more efficient transportation with lower cost transportation, energy efficiency, manufactured homes of the future being two-story, whether they're built two-story from the factory or you're using a superior wall system type thing to create two-story homes, to get more square footage out of each lot for larger families. And the amenities, we already create great amenities, swimming pools, tennis court, pickleball. But what our objective is to be a great place for people to live so that their income, their dollars earned, get the best value in a UMH community. So that when they pay their rent and they look at what they have, and this is what happened through COVID, people paid the rent. We maintained 95% occupancy and 98% rent collection through COVID because people knew if I lose this home, I'm going to wind up in a place that's not as nice and going to cost more. So that's our objective in 20 years, to be building communities just like that, to use our scale, our size, our ability to have the best engineers, to have, in 20 years, it'll be 73 years of experience building communities, to build the finest communities for people to live at the best price so they don't want to give it up and they want to pay the rent. And then there were other parts to your questions.
Well, I was going to say, what does a UMH look like, a property look like, and do you think we will still have, will there be more publicly traded players, less? What does that landscape look like?
Going to UMH, every year everything gets easier the larger we get. Our cost of capital's dropped. So think back when we were using 8.25% preferred. Sun Community had advantages over us by a mile. Their cost of capital was 2%. So if a perfect 300 space community in perfect condition, yielding 4% was available for sale, and our money cost 8 and their money cost 2, Sun was going to get it every time. It wasn't even a question. But we've created the ability to grow much more rapidly. So, I gave you the easy goals, and that my example I gave earlier, that's relatively easy. I believe we can achieve those goals I gave you earlier. But
5-year plans times 4, so that's 4x on FFO and dividend growth, right? Okay.
And so the larger we get, the bigger the projects we can do. You could build 1,000 space community. You can, have a presence in every state. You could be national. You could be international. there's really 20 years from now, not a whole lot of limit to what we can do as you use debt, equity, preferred to grow the company. Think back of where we were 20 years ago and how we grew to where we are today, and multiply that going out 20 years. It's pretty remarkable.
And that's why I'm sitting in UMH headquarters today, because we feel it's such a great story as we run the Home Appreciation US REIT ETF. We all need a house. We all need that roof over our head. It's the most important investment decision that you make every single day of your life. Sam, I have to say it's been a great honor to sit with you here today and have this conversation. I hope we could do this again sooner than 5 years, but we'll plan on that 5-year test. Again, my name is Dave Auerbach. I'm the managing director of Armada ETFs, and I was really honored to be joined by Sam Landy, the CEO of UMH Properties. Sam, thank you again.
No, thank you. And
Really
we appreciate the great questions.
Really appreciate it.
Thank you very much.
Thank you.